Let's talk about the Robin Hood tax. It's long been called this. This is a Labour Party policy. It's something actually been mentioned by a number of parties over the years. And it's basically a tax on transactions in the city. Not every single business deal, but specifically financial transactions in the city. Now, John McDonnell, the Shadow Chancellor, has put the plan, which levies a tax, as I say, on every financial transaction at the heart of his plans to overhaul the economy. He says that, yes, he's admitted it could be a gamble with the economy, but he has argued that there is so much money to be made from a very, very small levy that it would be sustainable for the city, and has claimed that it wouldn't actually mean that city firms would then choose to move to other destinations, other big city in Europe, say Frankfurt or Paris, to avoid that tax. Now, Sadiq Khan, the London mayor, also Labour, of course, has said the policy is madness. Let's talk about this, though, with Salman Shaheen, who's editor of the International Tax Review and joins us now. Good afternoon, Salman.
Good afternoon, Julia.
Right, well, listen, here's the thing. Now, most of us don't work in the city. Most of us don't deal with multi-billion or multi-million pound deals. What are we actually talking about here in terms of what this actual tax would be, what percentage it would be, and what sort of transactions it would cover?
I mean, it's being painted as something more extreme than it actually is. It's really just an extension of stamp duty. And let's remember, we've had stamp duty since the 17th century, and it's going to extend stamp duty onto derivatives transactions. So in terms of some sort of radical overhaul, I don't think it's that. I think it's much more in line with proposals that have been bandied around the European Commission and several core EU states over the last few years. So, I mean, I don't think there's anything too much to
This is not radical Maoist policy. But okay, you said this is basically an extension of stamp duty onto derivatives transactions. I understood some of the words in that sentence. What's a derivative transaction?
I mean,
break it down for us. Come on.
We're talking about futures and options here, really. I mean, without going.
I ask again. What's this is basically the mad gambling that you boys in the city all do, eh?
Well, I do work in the city, but for a magazine rather than a bank. But basically, I mean, one of the core arguments for financial transactions tax, and actually this is here where I would differ from John McDonnell's analysis slightly, because he says that an FTT should raise a considerable sum of money with a relatively low rate. Now, the thing about an FTT is the other positive benefit it could have is that it could constrain the kind of risky transactions, we're talking about high-frequency trading here, that precipitate financial crises. So in many ways, it could actually save the city a lot of money because it would rein in risky speculative high-volume transactions. Now, if that happens, then it would raise considerably less money than Labour might hope it would.
It's one of those taxes that you have to put at a point where it doesn't really affect what people do, but you still get the money. What sort of number? I mean, what sort of percentage would it be?
I believe we're looking at 0.5%, I believe. But I think these things, it's just a proposal at the moment, and these things need to be negotiated out. And don't forget that this is it's somewhat higher than the European Commission's proposals for a 0.1 and a 0.01%, which is at the moment in the long grass. But I think if that went ahead, and Britain was one of the major blocks on this, if that went ahead, then Britain might be advised, even post-Brexit, to align its rates with the lower European Commission rate, primarily because financial transactions taxes work best when coordinated cross-border.
Yeah, well, exactly. This is something that if internationally, if everyone knows all their trading internationally is covered by a certain tax, and then every country that's got it, they've got these big city institutions benefits, everyone's going to be happy. But the reality is, there's always going to be a country, even if we tried to do this internationally, you'd say, "Ha, I'll be the one that doesn't." And we saw this with corporation tax with Ireland, just offering these sweetheart deals, getting all these big companies to come and base their work there. But this is the thing: if we're going to do this unilaterally, then surely, I mean, although 0.5% sounds nothing, 0.5% on multi-million and multi-billion pound deals is going to be a heck of a lot of money for those firms. Won't they just take their business elsewhere? Is that realistic?
I think we have to ask the question, where would they take it? I mean, if you're talking about taking it to France and Germany, because obviously these the banks, financial institutions have to have a base in Europe. It has to be of time zone advantage. It has to be of skilled labour force advantage. So if it was going to move out of London, it would be to France and Germany. They are much further down the road towards the financial transactions tax than we are, of an opposition party that probably won't win the next election. They're far more advanced down that road. And Germany has been one of the chief proponents of this, as has France. And obviously, I suspect with Macron in now, that might be back on the table. So would they move there? I mean, I think if they were to move abroad, Brexit would be a much bigger factor here than the FTT.
I mean, yeah, and that's the issue, isn't it? I mean, there is some talk in the papers today of how France and Germany are rubbing their hands with glee at the prospect of us bringing in this financial transaction tax if Labour get elected, because that would make it much more of a temptation for these companies, these big institutions, to move out of London.
I don't see that. I think that the temptation is there with Brexit. That's certainly true. But as I say, France and Germany have been among the chief proponents of an FTT. All it would mean is that they wouldn't have that disadvantage now. It would be a much more level playing field.
Can I ask though, why wouldn't every country? I know we've had this issue over the years, haven't we? Sort of trying to close all these tax loopholes. We've got tax havens. I like to say most of the biggest tax havens in this world are actually former British colonies. Interestingly, we would in fact think we'd have some influence on them. We've got Jersey just down the channel. But this is the thing: why would it not be in every country's interest to have this tax? Everyone agreed to do it. Everyone would benefit from it. Every country that has this would benefit from it. And then there'll be no argument from the big city firms because they'd have no choice. Wouldn't it be in everyone's interest to do this?
Well, I suspect so. I think as ever with international tax, it comes down to a level of coordination, and the international bodies, don't really exist apart from the EU to oversee this kind of.
You say that they've been in existence 40 years and haven't managed to come up with it yet.
Well, I mean, the EC has a few years ago came forward with a proposal for an FTT. 11 countries then wanted to go ahead with it, but there's been all sorts of roadblocks to that, with failure to coordinate and some countries getting cold feet. And I do think it's always been said that if you are going to have an FTT, it should be coordinated, and I think that's the best approach. I mean, don't forget though, many countries, well over 30, have had some form of stamp duty for quite a while. And this raises $50 billion around the world each year. So it's not that these are completely new. It's a bit of a rebranding. And I'm not sure I'm entirely in favour of the name Robin Hood tax. I mean, it's a popular term that people can understand, but it makes the policy sound absolutely fabulous. I mean, whether people think it's a good idea or a bad idea, we get a lot of these things. It might be determined on whether or not you work in the city or not. But again, at that level, whether it is too big or too small is going to be the crucial amount. Because, as you say, the key thing is, it only raises money if the transactions are there. And if it's too high, you lose the transactions. But then you don't. There are certain transactions you don't want. You don't want sort of computer algorithms doing high frequency trading that have no real value and could destabilize the global economic system. It's much like a carbon tax. You don't want a carbon tax to raise money. You want it to stop people producing too much carbon dioxide. In this sense, yeah, it might raise a bit of money, but you don't want to raise vast sums of money through an FTT. You want it to be a stabilizing factor on the global economic system.
But you also want the money. Salman Shaheen.
My cake policy is pro-having and pro-eating.
Yeah, we'll see. But listen, thank you very much. Thank you very much for that. I like a Janet and John explanation. This is what we need. That's certainly what I need. Talk radio listeners much cleverer than me, I'm sure. Salman Shaheen is editor of the International Tax Review. Thank you very much indeed for talking to us. Much appreciated.